Imagine turning your $200 weekly investment into a portfolio worth over $2 million, all while raking in more than $14,000 every month in dividends. Sounds too good to be true? Well, it's not just possible, it's the power of smart dividend investing. In this video, I'm going to break down everything you need to know, from the basics of dividends to crafting a bulletproof portfolio that can grow exponentially over time. In the end, you won't just understand how dividends work, you'll be able to build your own portfolio. And also in the end, I'll show you and John how to combine these investments to create a portfolio that could transform your $10,000 investment into a portfolio worth over $2 million, generating $14,000 in monthly dividends. First, let's just talk about dividends, those little bonuses companies pay you just for holding their stock. Think of dividends as a company's way of sharing the wealth with its shareholders. Let's say you've bought shares or ownership in a company like ABC Corporation. Every time ABC makes money selling its products or services, it pays its bills, salaries, rent, and so on. What's left over after all those expenses is the company's profit. Now, ABC Corporation's management has a few choices with this profit. They could reinvest it back into the company to help it grow, stash some away for a rainy day, buy back some of their shares, or, and this is where you come in, they could send a portion of that profit to you as a dividend. This usually happens every quarter, so it's like getting a regular paycheck just for holding on to your shares. Why does this matter? Well, dividends can seriously boost your total returns as an investor. For example, the S&P 500, a major index, has a solid track record of returns. Over a decade, it's averaged about 10.92% annually just from price appreciation. But when you reinvest these dividends, that return jumps to 12.99%. That's the power of dividends. They can take your investment to the next level. Now, some might argue that dividends aren't the be-all and end-all. There's even a theory out there called dividend irrelevance, suggesting it shouldn't matter whether your returns come from dividends or the stock price going up. But here's the thing. Dividends offer a tangible, regular income that can help you ride out market ups and downs. They're like the steady part of your investment that helps keep you on track, especially when markets get bumpy. So, whether you're looking at companies that don't pay dividends like Amazon or those that do like Coca-Cola, the key is finding what fits your style. In the end, it's up to you to decide if dividends are the right move for your investing game plan. But I might change your mind, because I have a portfolio of stocks that can give you around $15,000 a month in dividends. Regardless of which dividend stock you invest in, if you're sold on dividend investing, take note of a few important metrics when you decide what kind of stocks to buy. Dividend yield is the expected annual dividend divided by the company's current stock price. For example, the yield for General Motors is 3.47%. How does that compare to other companies? Average yield varies depending on the industry. As a general rule, though, most dividend investors recommend a yield of about 4 to 6%. For example, money site PocketSense.com suggests that a good dividend yield will vary with interest rates and general market conditions, but typically a yield of 4 to 6% is considered quite good. Lower yield may not justify buying stocks for future dividend income, and a higher yield may indicate that the dividend is not safe and may be cut in the future. Yield isn't the only metric, of course. Simply investing in a stock because it has a high dividend yield is problematic, as some stocks with very large dividend yields are likely to have unsustainable dividend levels. Growth is another key metric in deciding whether a dividend is worth it or not. You don't need to look further than stocks that have increased their dividends for many consecutive years to find good, safe candidates for dividend investing. Some refer to these as ruler stocks, because if you laid down a ruler on a graph of dividends over time, the ruler would point to the northeast, and most of the points would be very close to the ruler. Experts refer to these stocks as dividend kings. There are 20 companies that have managed to increase dividends every year for the past 50 years. And that list includes 3M, Coca-Cola, Colgate-Palmolive, Genuine Parts, Hormel Foods, Johnson & Johnson, Procter & Gamble, and Tootsie Roll Industries. You should look beyond yield and start with stocks that have stood the test of time. Pay attention to another metric called dividend payout ratio. This measures the percentage of profits a company pays yearly to its shareholders. If a company earns $10 per share and pays a $5 annual dividend, that equals a payout ratio of 50%. It seems like a higher payout ratio would be good, but a lower ratio can tell you the dividend is safe because it tells you how much the company wants to reinvest its profits to grow the business. After all, whether it pays dividends or not, you still want to invest in a company that grows in value. Picking individual stocks is tough. It's also risky if you don't know what you're doing, and most beginners don't. It also kind of goes against the old Warren Buffett strategy of set and forget investing. The idea behind lazy investing is you pick a few solid funds or groups of investments that have performed well over time and sit on your portfolio for the long haul, adjusting every so often as you get closer to retirement. You can have the best of both worlds with dividend funds or the ETFs, exchange-traded funds. Instead of dividend yield, look for the term distribution rate. From there, you can buy into the fund the same way you'd buy any other fund in your investment portfolio. Even if you go with a fund, it's useful to be familiar with the key metrics. Like most investing strategies, dividends can get really complicated really fast. If you break it down, though, it's fairly easy to get started. While picking, it's not just the percentages or ratios you need to look at, you also need to look at some important dates, like the ex-distribution or ex-dividend date. This is the date on which you must own the ETF to be eligible to receive the next distribution. If you buy the ETF on or after the X date, you won't receive the upcoming dividend. Payment date is the date on which the dividend is actually paid out to shareholders. Now, if you're still following along, let's add taxes to the mix. The money you earn from a dividend can either be taxed as a qualified dividend or as ordinary income. Qualified dividends are taxed at a lower rate than ordinary income, between 0 and 20%, making them a much more attractive option than unqualified dividends. Unqualified dividends are taxed at your normal income tax rate, which can be as high as 40% if you're fortunate enough to earn that much money. So what makes a dividend qualified? First, the company issuing it has to be U.S.-based, or if it's a foreign company, it has to trade on a major U.S. exchange like the New York Stock Exchange. You also have to own shares in the company for more than 60 days of the holding period. So if you're in the 35% tax bracket and you have a qualified dividend, it'll be taxed at 15%. If it's not qualified, that means it's taxed as ordinary income at your 35% rate. Either way, to avoid paying those taxes now, you might want to keep dividends out of a regular taxable investment account and use a tax-advantaged account instead, like a 401k or IRA. Of course, that also typically means you can't touch the money until retirement. Otherwise, you can choose to reinvest the dividend. When a company gives you a dividend, you have the option to use that money to buy more stock in the company or reinvest. Some of the companies that offer investors dividends will also let them automatically use dividends to purchase more shares of the stock instead of receiving cash payments. This is called a dividend reinvestment plan, or DRIP, and dividends reinvested in more shares of the stock won't be on the hook for a tax cut. That's because stock dividends aren't usually taxable until the stock is sold. But if the dividend is reinvested and then the investor gets a cash payout instead of stock, it'll create a tax cut. It sounds obvious, but if you're pocketing that cash, whether through the dividend or by selling your stock, you're generally gonna have to pay taxes. And that tax hit can offset some of the lucrativeness of a dividend. But you can counter some of these tax obstacles with good dividend strategies. Let's look into how you can make dividends work for you. Picking the right strategy is super important because it's about what you want to get out of your investments. There are a few different ways to play the dividend game, depending on whether you're after quick cash, long-term growth, or a mix of both. First up is the high yield strategy. This is for those of you who want to see money coming in right now. You're looking at stocks that offer higher than average dividends, 5 to 7% or more. The cool thing about this strategy is that it gives you a solid income stream right away, which is good if you're retired or just want some extra cash flow. Take a stock like AT&T, which has a yield of 5.74%. That's some serious income. But remember, higher yields can mean higher risks. Sometimes these companies are paying out so much because their stock prices have taken a hit or they're in a shaky industry. So there's always the risk that they might cut their dividend, which could hit your wallet and your stock's value. Next, there's the dividend growth strategy. This one's for the patient investor who's thinking long-term. Instead of chasing the biggest yields, you're picking companies that consistently increase their dividends over time. Take Coca-Cola. They've been upping their dividend for over 50 years. The beauty of this strategy is that as these dividends grow, so does your income, helping you keep pace with inflation. Plus, companies that consistently grow their dividends are often pretty stable, which lowers your risk. The trade-off? You might start with a lower yield, but if you're in it for the long haul, the compounding effect can really pay off. Finally, there's the balanced strategy. Perfect if you're looking for a bit of both worlds, some income now and growth for the future. You'll mix high-yield stocks with those dividend growers, giving you a diversified income stream and the potential for your portfolio to grow over time. For example, you might pair a high-yield stock like Altria Group with a steady grower like Johnson & Johnson. The upside, you get flexibility with immediate payouts and future growth potential. The downside, it requires a bit more hands-on management to keep everything balanced and aligned with your goals. Whatever strategy you choose, it's important to keep an eye on your portfolio and make adjustments as needed. Markets change, companies evolve, and your financial situation might shift too. The most successful dividend investors are the ones who stay flexible and adapt their strategies to whatever life throws their way. Now that we've gone over how to spot the best dividend-paying stocks, it's time to build a portfolio that's both solid and diversified, aligning perfectly with your financial goals. The first step? Picking a mix of top-performing dividend stocks for the past 15 years. For long-term growth, I've handpicked 3 stocks that have recently become stars in my portfolio: Federal Agriculture Mortgage Corporation, UFP Industries, and Home Depot Incorporated. These companies not only have a strong history of paying dividends, but also show impressive growth potential. Sure, it's always good to keep an eye on what the big players like Vanguard, BlackRock, and JP Morgan are investing in, but these 3 stocks have really stood out for their consistent performance and reliability. To make the portfolio even more robust, I've added 2 real estate investment trusts, or REITs, American Tower Corporation and CubeSmart. These REITs aren't just about collecting dividends, they're also about smart diversification. Diversification is a key strategy in investing because it spreads your risk across different sectors, reducing the chance that one bad performance will drag down your entire portfolio. By including REITs like AMT and Cube, which are required by law to pay out 90% of their earnings to shareholders, you're adding a layer of stability. To wrap things up, I'm also including the ProShares S&P 500 Dividend Aristocrats ETF. This ETF is like a one-stop shop for exposure to high-quality dividend-paying stocks, focusing on S&P 500 companies that have been increasing their dividends for at least 25 consecutive years. When it comes to evaluating how well these dividend stocks perform, there are a few key metrics that really matter. Take Federal Agricultural Mortgage with the ticker AGM. It offers a current dividend yield of 2.72%, which means you're getting a steady income stream just by holding the stock. But what's really impressive is its dividend growth rate of 25.4%. This shows that AGM has been consistently upping its dividend, which is a great sign of the company's financial health and its commitment to rewarding shareholders. And on top of that, AGM has a 10-year average share price appreciation of 18.48%, meaning it's not just about dividends, the stock also has serious growth potential. These metrics are crucial because they help you gauge how reliable the dividend is, how much it might grow, and how much value the stock could add to your portfolio over time. The other stocks in this portfolio have similar strong metrics, reflecting the same careful approach to income, growth, and stability, which is exactly what you want for a well-rounded and resilient investment strategy. If we average out the metrics of these 6 stocks, which you can simply do by adding all the respective yields divided by the number of stocks, which in our case is 6. For this portfolio, we have a current dividend yield of 3.08%, a dividend growth rate of 17.86%, and a healthy annual share price appreciation of 13.77%. This diversified mix ensures a balance between immediate income and long-term growth potential. Looking into the future projections of this portfolio, let's take John's $10,000 for a run. After 10 years, this portfolio could grow to approximately $50,088. After 20 years, the compounding effect becomes seriously pronounced, with the portfolio potentially reaching $292,789. Fast forward to 30 years, and this portfolio has the potential to grow to an impressive $2,144,262. By this time, the annual dividends alone could amount to $170,476, translating to a solid monthly income of $14,206. Breaking down these projections further, over 30 years, the total value added to the portfolio would be around $2,134,262. Of this, $1,332,425 would come from the appreciation in the share prices of the dividend-paying stocks, while $801,837 would be the result of reinvested dividends. Want to get paid every week? Click the video on the screen to find out how to create a portfolio that can pay $200 every week, starting from the very first week.